All right. Hello, everyone. Looks like we have a good group of people. We got about 13 folks that have joined us, and hopefully a few more as we start. And so thanks all for joining us. As our emails and Facebook page have indicated, Waymark will be hosting these monthly workshops. So this is the first one. So we're really thrilled to have Kurt with us today. He, as we mentioned in the emails and the invitations, he was the Social Security Administration's former regional communications director for New England. I think that the New England part doesn't really necessarily apply. You know, New England, this is a federal program, so therefore, he's going to be able to speak to pretty much the entire program, and everything is pretty much specific to, or isn't specific to, the state of Massachusetts. I know we do have a few folks joining us from outside of Massachusetts, so that's that. So again, just as indicated in the email, we'll be doing these on a monthly basis. This is a new thing for us. Next month's seminar is going to be on estate planning, so basics on estate planning like wills, powers of attorney, etc. We also will be talking about some year-end tax saving strategies in November, budgeting around the holidays, obviously in December, some divorce planning, health insurance and Medicare, and improving your credit score. So that's all in 2020. So as I mentioned, Kurt has joined us. He is, as we were talking about prior to the workshop, semi-retired.
Semi-retired. Living the dream one day at a time.
So this is what he does, as his quote unquote semi-retirement job. So he does workshops like this for groups, but also does meet with people individually. So if at the end of all of this you think that it might make sense, especially if you're about around that time where you actually have to make a decision, Kurt may be your guy. To speak with one-on-one to vet out your different options. So we'll try to keep, ground rules here, try to keep this about 30 to 45 minutes, then open it up for questions for another 15 minutes. And depending on how long those questions last, we'll try to do a hard stop at 1 hour to respect everyone's time. To ask any questions, there is a Q&A button at the bottom of your screen that you should be able to see, and you can type in your question. We'll see it. It'll pop up on our screen, but not everyone else's screen. And we'll try to answer that if it's within the context of what Kurt's talking about. If not, we'll just table it for later on the conversation. And we'll also have a few interactive polls that I'm going to start right now, which is just to get an idea of what we actually are looking at in terms of who we have on the call. I'm going to ask you, this is anonymous, so don't get too hung up on this. You can choose how old you are so that we can kind of get an idea of where we are with the audience here, just so that Kurt can kind of tailor the presentation towards that. So we're getting a few responses. We got about 60% of the people voting so far. It looks like everyone's pretty much around, obviously. 62 and 62 is the bulk, or younger than, so it looks like we have a number of folks that are starting to think about this, and it's becoming actually a real decision that they have to make. So that's great. Thank you for voting. We'll end the polling here. Pretty much the results. That's what we're looking at. And what I'll do from here is make this presentation a little bit bigger for the screen, and I'll turn it over to Kurt. So Kurt, go for it.
Thank you. Good afternoon, everyone. Good to be here. As Brendan said, I'm Kurt Czarnowski. I'm currently the principal in Czarnowski Consulting. Proud to say we're an international consulting firm whose world headquarters are conveniently located in the basement of my house in Norfolk, Massachusetts. At Czarnowski Consulting, we like to say we provide expert answers to your Social Security questions. And why can I say that simple, as Brendan mentioned? I worked for the Social Security Administration for 34 years. Last 20 years, I was the communications director in New England, which meant I spent my time out talking to folks about the program. And in my retirement, such as it is, continue to do that same type of work, largely because I enjoy it, but also because I believe there's a real need for the information Believe it or not, the Social Security program is now a little over 84 years old. Each and every month, Social Security pays about $84 billion in benefits to about 63 million people. And on top of that, there's another 177 million folks who are now out there working and paying into the program. And what I saw during my time at the agency, and now that I'm on my own, is despite the age of the program, despite the size of the program, despite the economic impact that Social Security has in this country today, the myths and misunderstandings that are out there about what it is as well as what it isn't are overwhelming. Nobody knows nothing about Social Security. So hopefully in our time together today, spend a little time helping you better understand what the program is, recognize what it isn't, dispel some of those myths and misunderstandings, and set you down the road to the comfortable retirement we all hope to enjoy. Next slide, please. Most important slide in the presentation is going to be this one. You'll hear me reference it over and over again. People need to understand that when Social Security was created a little over 84 years ago, it was put in place simply to provide people with a base or a foundation of income. They can count on being there for them, but it's a base or foundation that people must take steps to supplement. But unfortunately, these days, for about 21% of retiree couple households, the Social Security money that comes into them each month is virtually the only income they have. A terrible situation. So how to avoid that happening to you? Simple, by planning for retirement, obviously, and you'd be commended. Taking a little time out of your busy day, spending some time with me today, planning for this aspect of retirement, Social Security. Next slide, please. Now, for the longest time, the Social Security Administration had tried to play an active role in helping you plan for your retirement. Because back in the day, meaning back starting in 1999, Social Security would mail on an annual basis a document to everyone, a Social Security statement. It would go out to anyone who was 25 years of age or older, who had ever paid into the Social Security program and who was not yet collecting benefits. That Social Security statement designed to provide you with a benefit estimate of retirement payments at 3 ages, 62, your full retirement age, or 70, but also provided a very nice year-by-year breakout of what Social Security had recorded as your work and earnings under the program. We'll see in a little bit what you eventually collect each month is directly related to what your work and earnings have been. So it was important to look at that information, make sure that the earnings credited to you were accurate, because if they weren't, it was important to catch it and correct it, because if you didn't, it would have a direct impact on what you eventually received. We may have noticed, I haven't got one of those over a year lately. What's the deal? Well, Social Security has cut back on the distribution of paper Social Security statements. And first and foremost now, they no longer mail a paper document to everyone aged 25 years of age or older. Instead, what they have set up is a system whereby if you go to, URL is on your screen, www.socialsecurity.gov/myaccount, and take about 10 or 15 minutes or so to set up your individual Social Security account. An important byproduct of having that account in place is you'd be able to download a Social Security statement for yourself whenever you need or want one. You're going to come in and do some retirement planning. Having set that account up will enable you to have a current statement in hand, which is going to make that a more worthwhile exercise. So big message from me is that's how you primarily get your hands on a Social Security statement, is by setting up your individual account. And if you haven't done yet, I encourage you to do so. But Social Security has announced they've decided to resume mailing paper documents, albeit on a very limited basis, though. And here's what they say is if you are 60 years of age or older and haven't set up an account, they will mail you a paper statement, same old schedule, about 3 months before your birthday. But that's it for mailings. Anyone under the age of 60, the only way you get a statement is by setting up your account. But in my view, even if you're over the age of 60, I think it makes sense to set that Social Security account in place, because then again, you're going to come in, do some retirement planning. Having a current statement in hand is going to make that a more worthwhile exercise. So key message from me, take advantage of this planning tool. Next slide, please. But one of the things about the statement gives you benefit estimates only at 3 different ages, 62, your full retirement age, or 70. And in preparing the estimate, because Social Security has no idea what your future work plans are, they base the calculation on an assumption that you're going to keep working, making the same amount of money you've been making for the past couple of years. We know as well as I do in planning for retirement, may be interested in collecting at ages other than just those 3. May also be interested in figuring out what would happen to your Social Security benefit if, I don't know, you quit work on Friday and never worked another day in your life. So another retirement planning tool you should avail yourself of is Social Security's online retirement estimator. Beauty of the estimator is it allows you to develop what-if scenarios to your heart's content. You can find out how much you'd get if you started to collect at, oh, I don't know, 64 years and 4 months, or 68 and 8 months, or whatever age you're interested in. And or you can also find out what would happen to your Social Security payment if you did indeed quit work this Friday, never worked another day in your life. So a key message from me, you got to plan for retirement. You got to recognize the Social Security program intended to provide you with that base of income, that foundation that you can count on being there. But you got to find ways to supplement it, because it was never intended to be your only source of income in retirement. So take advantage of those planning tools. Next slide, please. So let's talk about retirement benefits. That's where most people call or approaching that. And as I travel around the country and talk to folks about retirement benefits, most frequently asked question has to be, well, when should I take my money? Well, understand this. You've got choices and you've got options. And what I'm trying to do today is help you understand what those choices and options are. In other words, I want to help you understand what you can do under the program. But ultimately deciding what you should do, well, in my view, that's your choice, your decision. You're the ones who worked and paid into the program. I can't tell you what you should do. But what I can do is tell you what you can do. And my view is, if you don't fully understand what you can do, you're in no position to make that informed choice about what you should do. So let's make sure you understand your choices and options. And the place to start is by making sure you know what Social Security calls your full retirement age. When the program started back in 1935, full retirement age set by Congress as the month you turned age 65. And when it was age 65 for everyone without exception. And continued that way, frankly, till 1983, though, when Congress changed the law, increased full retirement age for anyone born 1938 or later. This increase gradually been phased in over time. We're now at the point for a big chunk of the baby boomers, anyone born between 1943 and 1954, full retirement age is the month you turn age 66. But it's important to note, it continues to increase beyond that. And under current law, it tops out anyone born 1960 or later. Social Security full retirement age is the month you turn age 67. You understand this, collecting at full retirement age, that's not your only choice. It's not your only option. But you need to make sure you know what your personal full retirement age is based on your year of birth. Because you'll see as we go through the discussion today, a lot of features of the program do flow from at least having reached your full retirement age. So make sure you know what yours is. Next slide, please. In terms of collecting benefits, though, you have to start the month you hit your full retirement age. That means one thing and one thing only. It means you'll get 100% of the amount your work and earnings entitled you to receive. And we'll talk in a second how that all gets calculated. But starting at full retirement age, you get 100% of your benefits. But among the many options you have are start before reaching full retirement age, if that makes sense for you. And under the rules today, you can start to collect payments as early as age 62. But here's the thing, Social Security, as the name implies, is a social insurance program. And Congress has built certain social goals into it. And one is a hope that everyone ends up with roughly the same amount of lifetime benefits, regardless of when they start to collect. And so, under the rules, you have to start taking your money before you hit that full retirement age month. Well, now, by starting earlier, in theory, then, you'll now be collecting for a longer period of time. Well, you'll find that your monthly payment amount gets reduced. How much of a reduction? Well, it's roughly 0.5% per month for each month prior to your full retirement age you have to collect benefits. 0.5% per month, roughly a 6% per year haircut. But again, you don't have to start right on your birthday. You don't have to start the first of the calendar year. But if you opt to collect before hitting that full retirement age month, your benefit amount is going to be reduced by roughly 0.5% for each month that you collect. And oh yeah, by the way, it's a permanent reduction. None of those myths that I've encountered. Too many folks mistakenly think, yeah, I know I'll start early, I'll get less, but as soon as I hit my full retirement age, my payment will zoom back up. Permanent reduction, again, the idea being you're starting sooner, in theory collecting then for a longer period of time, so you're given less on an individual monthly basis. As I mentioned, you start right at full retirement age, that's when you get 100% of your benefit. But among the options you have are to wait past full retirement age before starting, if that makes sense for you. And with that social insurance idea in place, you opt to delay. Well, now by starting later, in theory then, you'll be collecting for a shorter period of time. So you'll find that by waiting, your monthly payment amount ought to be increased. And it is. These are referred to as delayed retirement credits. And for each month past your full retirement age, you opt not to collect your benefit. You'll find your payment amount now been permanently increased by 2/3 of a percent. 2/3 percent per month translates into an 8% per year increase by waiting. But again, you don't have to not collect for a full year to accrue these delayed retirement credits for each month past full retirement age that you defer. Benefit permanently increased. But here's the key thing. Delayed retirement credits only accrue from full retirement age until the month you turn age 70. Full retirement age to age 70. Now understand this, you never have to take your Social Security payments. It's not like there's a required minimum distribution or anything. But if you opt to defer from your full retirement age until age 70, you'll see your payment increase by 2/3 of a percent for however many months you didn't collect. But you opt to wait past age 70 before starting. That's an option you have, but you're not going to see any additional increase because you waited past age 70. Next slide, please.
Can I just jump in on this?
You certainly can.
One of the things I was showing to Kurt was a kind of a picture of what Kurt just kind of walked through. It also gives Kurt a chance to grab a glass of water. But bottom line is there are two segments here. This is if your birth year was 1954 or earlier, your full retirement age is age 66. If you took it out at age 62, you're looking at about a 75% full retirement age benefit. If you took it all the way out to age 70, you're looking at about 132%. If you look at the 1960 or later, your now full retirement age is age 67, where you would get your full benefit. But if you took it early, you'd only get about 70% because, again, now we're looking at 67 minus 5 years at a 6% drop each year. And then versus the age 70, what Kurt was pretty much saying a moment ago is you only have from 67 to 70 to grow at 8% per year, so you get about 124%. And so this is another way of looking at it. And then each one of these in the middle here is, this is birth year 55, 56, 57, 59. This is a slide that I could share with you. So if you are interested in seeing this slide or another slide that I'm going to show probably a little later in the presentation, feel free. I'm happy to share that with you.
Yeah, and then the next two slides I was going to covered exactly the same thing. I'll give you a couple of examples of people. First one, we'll talk about someone with a full retirement age of 66. And then pointed out, you start full retirement age of 66, you start at age 62, you get 75% of your benefit amount. At your full retirement age of 66, you get 100%. You wait all the way until age 70. You see that 8% increase each one of those 4 years means you're receiving 32% more. And the important thing is it's simple interest, not compounded, but it's 132%. Next slide, please, is just a similar information for somebody with a full retirement age of 67. Reinforcing, start at age 62, still allowed to do that under the law, but you're going to see a greater reduction in your benefit. Full retirement age of 67, you get 100%. At age 70, 3 years worth of delayed retirement credits means your payment's 24% higher. Bottom line, though, on all of these, as I said, it's your choice, your decision. You're the ones who've worked and paid into the program. Now, what are the things I think you should be thinking about? Well, they're the obvious ones that I'm sure you already are. Your health, for one, longevity for a second factor. You need the money. You're going to keep working. All those factors come into play. But the whole idea when Congress set this up was that based on average life expectancy, it was all supposed to come out about even. But the important thing to me these days is life expectancy is increasing. Social Security numbers say if you're a 65-year-old man today, on average, you're going to live to age 84. 65-year-old woman, on average, you're going to live to age 86. But even more telling to me, Social Security numbers say today's 65-year-olds, 1 in 3 expected to live to age 90, 1 in 7 age 95. We baby boomers need to focus on the fact that retirement for us could be a period of 20, 25, or maybe even 30 or more years in length. And my personal view tends to be, for most boomers, as they head into retirement these days, if they have any type of pension at all, It's far more likely to be the defined contribution type, 401k, 403b, 457, where you're walking out the door, not with a guaranteed stream of lifetime income like you used to get with that traditional defined benefit pension. No, you're walking out the door with a pile of money. So it seems more likely to be that later in retirement, that pile of money will have diminished somewhat. Later in retirement, healthcare costs may be higher. So you may have a greater need for a higher monthly income later in retirement than when you make that initial transition. And one way you can meet that need is by delaying the start of your Social Security benefit. But again, it's not for me to say. It's someone's individual choice, individual decision. I just want to make sure you're making an informed decision, which is you start sooner, you get a lower amount for the rest of your life. You wait longer before you start, you get a higher payment amount for the rest of your life. But again, when Congress set the reduction rate, the increase rate so many years ago based on average life expectancy at the time, it was all supposed to come out about even. But now, because life expectancy is increasing, I tend to think that good things come to those who wait. But again, not for me to say your choice, your decision. Next slide, please.
All right, I'm going to share a couple. I'm just going to jump in again.
Yeah, absolutely.
I'm going to share another slide because we have gotten a couple questions about, the average age or average lifespan of a healthy male. What's the optimal age to start collecting? And I'm sure Kurt will talk about collecting Social Security while you're employed.
Yep.
But we'll talk about that in a minute. But I want to show you a slide again. This might be a little bit too much detail, but I do think that it's, for those of you who can follow along with this slide, I think it pretty much, again, echoes the point that Kurt was talking about. So specifically what this is saying is that if the client's full retirement age is 66 and 6 months, but this is, I wouldn't get too hung up on that amount. Bottom line is if you start taking your retirement benefit at age 62, we know that it's a lower amount. In this specific case, the full retirement amount would be $1,653 per month. For this person, it would be reduced to $1,080 per month, but you actually have 4 years of a head start rolling that cumulative pile of money that Social Security is actually given to you. And so what this chart is actually showing is that right around age 76 is when it would have been better for you to have claimed your full retirement benefit or your retirement benefit at full retirement age in order to maximize this. And down here, it's pretty much saying this is the probability that if you were a man, female, or a couple, that you would live to that point. So it goes back to, the law of averages. In the case of men, 27%, it would have been better for them to claim it at age 62 because they will have passed on between age 62 and 76. For a woman, in general, again, looking at these statistics, 81%. So it's actually more beneficial for a woman to actually wait until full retirement age or longer to claim hers. And so what you see here is the break even for taking it at age 70 is right around 80. So that's really kind of where that break even actually happens. So from a longevity standpoint, if you have a lot of longevity in your family, and there are a lot of people that live to age 80 and longer, then you may want to think about delaying a little bit longer than normal. But again, it's something that I've talked to a number of clients about is if you actually need, so that's one side of the argument. One side of the argument is delay as long as you possibly can because, again, looking at percentages, there's a 60% chance if you're a guy that you'll be living age 70 and further, 71% if you're a female, and 88% if you're a husband-wife. That's one side of the argument. Other side of the argument is if you're out of work at age 62 and you need to actually start claiming or actually start drawing from your investment portfolio, and let's say it's 2008 and the market's down 30%, do you want to take from your investment portfolio and start selling things at that discounted negative 30%? Or do you want to get, quote unquote, free money from the government to supplement your lifestyle? So it's not an easy question to answer. It's individualized for every single person. But, you know, at the end of the day, if you're just looking black and white at this, you know, there's a very high likelihood that you will be here later on in life, so it would make sense for you to delay as long as you possibly can.
All right, so let's move on from the when you can collect to how benefits are figured. The second area I get questions about all the time. And important to note, as I mentioned before, there's a relationship between your work and your earnings and what you receive each month from Social Security, but we'll see in a second it's not a perfect correlation. But in calculating payments, Social Security simply uses the formula that Congress has written right into the law. Formula has a number of different steps. First step is that Social Security will go back and adjust all of your prior year earnings for inflation, bring them all up to what they are in today's dollars. But then once they've done that, they calculate your benefit by plucking out and averaging your highest, wait for it, 35 years of work under the system. Another huge area of misunderstanding. I don't know how many folks I've talked to over the years mistakenly think, well, it's based on my high 3 or my last 5, like some other pension systems. Social Security benefits are calculated by averaging your 35 highest years of work under the system. So what happens if you don't happen to have 35 years where you've actually paid into Social Security? You've taken time out of the workforce to raise kids, care for aging parents, or perhaps work for a while in a job where you hadn't been paying into Social Security. No provision for that. It's still going to be an average of your 35 highest years of earnings, and Social Security applies a formula to that to determine your monthly benefit amount. Next slide, please. Here's what I want to emphasize again today is Social Security and that social insurance program. And putting the formula in place, Congress has recognized that people in lower paying jobs, less likely to have a pension of any type, less likely to be able to save for retirement during their working years because they need their money for food, clothing, and shelter. So the system does try and help people in lower paying jobs by providing a benefit amount which is intended to replace a higher percentage of their pre-retirement income, some in the neighborhood of 55%. For a higher earner, by all means, they get more each month in absolute terms, but if you look what that payment represents, designed to replace a smaller percentage of someone's pre-retirement income. And for the average earner these days, the key point is Social Security payment only designed to replace around 41% of what you're making. And in no case, low earner, high earner, or average earner is the payment intended to replace 100% of what you're making. It leads us right back to that first slide I showed you. You got to understand the program's designed to provide you that base of income, that foundation, but you got to find ways to supplement it because it was never intended to be your only source of income in retirement. Two numbers you think about this afternoon. 2019, the average Social Security retirement benefit being paid, $1,461 a month. $1,461 a month, a little over $17,000 a year. Then the question comes up, is there a maximum payment? Well, qualify it by saying in 2019, somebody who was at full retirement age of 66 this year and who for each of the past 35 years has had earnings at or above whatever the taxable maximum has been, because that's an important point. Each year there's a maximum level of earnings upon which Social Security tax is imposed. This year you could make $500,000. You only pay Social Security tax this year in the first $132,900 that you make. Anything above that, you'll pay a Medicare tax, but you don't pay that 6.2% Social Security payroll tax. Well, when it comes time to average your earnings to calculate your benefit, Social Security only averages the earnings up to taxable maximum for a particular year. So to recap, 2019, somebody at full retirement age of 66 this year who for each of the past 35 years has had earnings at or above whatever the taxable maximum has been. This year, he or she receives $2,861 a month, close to $35,000 a year in Social Security. Nothing to sneeze at, but it's a base, a foundation, and you got to find ways to supplement it. Next slide, please. So let's move on to talk about working in retirement. We have a question on that, but it's another area that I get questions about all the time. And here's another area where it's important to know what your Social Security full retirement age is. Because under the rules of the program, if you are under your full retirement age, looking to collect benefits, but intending to work at the same time, you need to understand that you're limited in how much you can earn before it begins to impact your ability to collect. And in 2019, if you're under your full retirement age, you're allowed to make up to $17,640 without any loss of benefits whatsoever. To make $17,640 or less, you'll be paid full Social Security payments every month of the year. You make above that, doesn't mean you can't necessarily collect at all, but Social Security then starts to hold back $1 in benefit payments for each $2 that you're over the threshold. So what counts towards that $17,640? Two things only: wages and or net income from self-employment. In other words, earned income only. That whole wide world of unearned income you might be receiving, a VA benefit, General Motors pension, 401k distributions, bank interest, dividends, none of that counts towards that $17,640 threshold. But the good news is, from the month you reach your full retirement age on, there's no longer any earnings limitation imposed on you whatsoever. And from full retirement age on, you can work and earn as much as you like and collect Social Security payments at the same time. Now, people frequently ask, hey, I'm retired, but I'm going back to work. I don't have to pay Social Security tax on my earnings, do I? Well, yes, you do if you're in a job covered by Social Security, which is good news for the folks at Social Security because they can use the money. But there's potentially good news for you as well. We mentioned your benefits always calculated by averaging your 35 highest years of inflation-adjusted income under the program. And so, even if you consider yourself retired, you go back to work, you're in a job covered under Social Security, the good news for you is if the earnings that you've had are higher than the lowest of the 35 years that Social Security had been using to calculate your benefit, you file your tax return, Social Security does a match, and they will automatically recompute your benefit. They'll drop out the lowest of the 35 years, plug in this new higher year, and will result in a payment increase for you going forward. And this ability to increase your payment through additional work and earnings, it continues forever. Delayed retirement credits, yeah, they stop at age 70. No additional bump past age 70 by not collecting. But no matter how old you are, if you're working, paying into the system, and your earnings are higher than the lowest of the 35 years that had been used to calculate your benefit, well, it's going to be automatically recomputed each and every year, giving you credit for that higher year of earnings. And the other bit of good news, frankly, about work is it never hurts. So you've been a high-priced executive, but in retirement, take a part-time job at the local golf course, driving the beer cart around. You make a couple $1,000 bucks. Well, at the end of the year, that couple $1,000 is probably going to be lower than the lowest of your 35 years. So what happens to your benefit amount? Nothing. It stays the same. It's always based on your 35 highest years of inflation-adjusted income. So I said a while ago, I think good things come to those who wait. I think good things can come to those who work as well. Because as long as you're working, paying into the system, there's always the possibility that your payment's going to go up. It's never going to go down. Next slide, please. Let's go into a discussion about spousal benefits, survivor benefits, divorce spousal benefits. So we'll touch quickly on the one remaining Social Security claiming strategy that's still out there that people might be able to take advantage of. The spousal benefit program under Social Security has been around for 60 or 70 years, put in place by Congress to support the model of the American family of the 1950s and the 1960s. So whenever I discuss spousal benefits, I illustrate it by referring to what in my baby boomer estimation was the prototypical American family of the 50s and 60s. It was the Cleaver family from the TV show Leave It to Beaver, because Ward Cleaver, he was the breadwinner, he worked. June Cleaver, she was a stay-at-home mom. And Social Security basically supports the Cleaver family model in its spousal benefit program by saying that Ward Cleaver, breadwinner, he'll get a benefit based on whatever that work he was under did. So let's say he gets $1,000 a month at his full retirement age. June Cleaver, as Ward's spouse, at her full retirement age, is eligible to receive a payment amount equal to 50% of Ward's full retirement age amount, or in our example, $500 a month, that's paid to her in addition to what's paid to Ward, and it's paid to her even though she may not have worked a day outside the home in her life. Now, for June to collect as a spouse, though, a few conditions have to be met. First and foremost, Ward Cleaver needs to be collecting before June can receive that spousal payment. He must be collecting. Second, for June to collect as a spouse, just be at least age 62. Earliest age, spouse can collect no different than on the retirement program. If she's at her full retirement age when she applies, that's when she gets the full 50% of his full retirement age amount. If she's younger than that, it's reduced. And that's the third key point. The spousal payment is based on 50% of Ward's full retirement age amount, not necessarily 50% of what he may actually be collecting. So for example, Ward, full retirement age amount 1,000, but he waits till 70 to start to collect. So he's receiving $1,320 a month. At her full retirement age, June's spousal payment is still only going to be $500 a month, 50% of the full retirement age amount. That's the 50s and 60s. Let's flash forward 70s, 80s, beyond, because now in all likelihood, June Cleaver will have worked outside the home, will have paid into the Social Security program, and will have earned a benefit on her own. How does that all work together? So let's say Ward still got his $1,000 full retirement age amount, but June's earned a benefit on her own of $800 a month. They had the Social Security together. Ward gets his 1,000, June gets her 800. Social Security is about to say goodbye and good luck, and June goes, hey, no, can't fool me. Where's my $500 spousal payment that I've heard so much about? At that point, the good folks at Social Security go, sorry, June, as Ward's spouse, you can receive that 50% of his full retirement age amount or your own, one or the other, whichever one is higher, but you don't get both benefit amounts at once. Because in our example, her $800 benefit exceeds 50% of Ward's full retirement age amount, that's what she'd collect. Now, say she hadn't worked that much, though, so her own benefit was only $250. Well, sure, at that point, Social Security would give her an additional $250 on top of her own, bringing her up to that 50% of Ward's full retirement age amount. Spousal benefits. Incidentally, the program's absolutely, totally, completely gender neutral, meaning, say the Cleavers had been ahead of their day back in the 50s and Ward was the stay-at-home dad and June was the primary breadwinner, then everything I talked about here would be equally true, that he could get 50% of her full retirement age amount or his own. But it's always one or the other, not both at once. Next slide, please. Let's flash forward, though, and talk about survivor benefits. And here's some good news for June. That's if Ward dies. Because now, with widows and widowers, the basic rate for June is not going to be 50% of Ward's full retirement age amount. No, it's going to be 100% of his benefit. Oh, yeah, still, or her own, one or the other, whichever one is higher, not both at once. So, for example, Ward's getting 1,000, June's getting $800, Ward dies, assuming June's at her full retirement age amount, she'll immediately begin to receive an additional $200 a month, moving her from her own $800 benefit up to that $1,000 level that Ward had been receiving. That's the good news. Bad news, though, if you think about it, while he was alive, they were getting $1,800 a month in Social Security payments. His 1,000, her 8. He dies. Well, sure, her individual payment goes up, but it's like her old benefit goes away. It's just something you need to plan for because it's one or the other, whichever one is higher. The other point I want to make is this. So Ward, full retirement age amount 1,000, but he opts to wait until age 70 so that when he passes away, he's receiving $1,320 per month. Well, the better news for June is now her own benefit, that $800 payment, increases past the 1,000 all the way up to the $1,320 that he had been receiving. Remember that by opting to wait, not only is your own benefit higher than it would be if you started sooner, but it also means that any survivor payment that could be made after your passing is going to be higher as well. Another reason why I tend to think good things come to those who wait. A couple other points. Widows and widowers can start to collect as early as age 60, but the same concept holds. You start early, you get a reduced amount. And then it's important to remind folks, though, that under the rules, say you have worked and paid into the program and your spouse passes away. Well, sure, you collect on one account or the other at a time, but it is possible to sequence the collection of benefits, start to receive a reduced payment amount, for example, on one account, and then at full retirement age, switch over and collect a full unreduced amount to the other. So, for example, June Cleaver, widow at age 60, opt to collect a reduced survivor benefit, collect, and then at her full retirement age, at that point, apply for and receive a full unreduced retirement benefit based on her own work activity, or perhaps she even waits until age 70 before claiming her own. Again, you get one amount or the other at a time, not both at once. But it's important to point out, if anyone is under full retirement age, whether you're looking to collect a retirement benefit, a spousal benefit, or a survivor benefit, and you're working, you're going to be subject to that earnings limitation we have referenced a few slides ago. So June Cleaver, widow at age 60, still working, making $500,000 a year. she's not going to be able to receive that survivor benefit, not because she's not old enough, not because she's not a widow, but under full retirement age, work and earnings impact someone's ability to collect. But June continues to work. At full retirement age, that earnings limitation goes away, so she could conceivably claim the survivor benefit then, be paid that even though she's still working, defer collecting her own, and at age 70 file for her own retirement benefit, and she'll have maximized it by waiting all the way until age 70. So important to note, you collect on one amount or the other at a time. You don't get both payment amounts at once, but it is possible to sequence the collection, because you can collect on one and then switch to the other. Next slide, please. So a quick reminder about divorce. So after many happy years of marriage, Ward had run off with his 24-year-old secretary, and June divorced him. Can she collect as a divorced spouse? Well, if a few conditions have been met. First and foremost, the marriage needs to have lasted at least 10 years prior to the divorce. Generally, for regular spousal benefits, it's simply a 1-year duration of marriage requirement, but in cases of divorce, marriage needs to have lasted 10 years. Second, for June to be able to collect, she cannot be married. She has to be unmarried. Ward, he can have remarried without impacting her ability to collect on him, but for her to be able to collect as a divorced spouse, she cannot be married. Thirdly, has to be at least age 62 or older. Earliest age a divorced spouse can collect, no different than regular spousal benefits. Now, remember when I talked about spousal benefits, I said June couldn't collect unless and until Ward was actually collecting. But what the law says in cases of divorce, as long as they've been divorced for at least 2 years, and both of them are at least age 62, he can begin to collect based on his work record, even if he has not yet started to collect. Again, divorce has to have been finalized for at least 2 years. They both have to be at least age 62. She can collect based on his work record, even if he has not yet started yet. So with those conditions being met, what's she entitled to receive? Simple, as if the marriage was still intact, she gets 50% of his full retirement age amount or her own, one or the other. He passes away, 100%, or her own, one or the other at a time. And the last bullet, the law treats divorce spousal payments as absolutely independently from anyone else in the record. So Ward could have a whole series of 10-year marriages. Each one of those exes could potentially collect without impacting anyone else's benefits. So we talked about spousal benefits, survivor benefits, divorce spousal benefits. Next slide, please. I want to quickly bring you up to date on a Social Security claiming strategy that is rapidly going the way of the dodo. This is something called claim some now, claim more later, sometimes referred to in the literature as filing a restricted application for benefits. So what was it all about? Well, we'll illustrate it with the cleavers. This was a situation where both Ward and June had worked. Both had paid into the system. Let's say Ward's got a full retirement age amount of 1,000, June full retirement age amount 800. June decides to collect. Ward, though, says, you know what, I'd like to wait. And he's wondering, is there some way he can get some money while he waits to claim his own retirement benefit? Under this old claim some now, claim more later strategy, there certainly was. June's collecting. But if Ward waited until his full retirement age, he had the option at that point of, in essence, picking and choosing. He had the option of taking just the spousal benefit, receiving 50% of June's full retirement age amount, without first having to claim his own retirement benefit. By doing that, he'd be paid something, but in the meantime, his own benefit would be accruing delayed retirement credits growing by that 8% per year. Key thing was June had to be collecting and Ward had to be at full retirement age. Because if you went to Social Security before reaching full retirement age, you didn't have that option of picking and choosing, if you will. You were always deemed to be applying for both your own retirement benefit and the spousal benefit, and you'd be paid one or the other, whichever one were higher. So that's the old law. What's the new law say? Well, the change was all brought about November of 2015 with passage of something called the Bipartisan Budget Bill of 2015, which allowed for a phase out of this strategy. And under current law, if you were born January 1st, next slide, please. Born January 1st, 1954 or earlier, if you have reached your full retirement age and your spouse is collecting, you still have the option of filing a restricted application claiming just the spousal benefit without having to take your own retirement benefit first. One more time, born January 1st, 54 or earlier, at your full retirement age of 66, if your spouse is collecting, you still have the option of taking just the spousal benefit without first having to take your own. But anyone born after January 1st, 1954, in the vernacular, you are SOL, and you no longer have the option of utilizing the strategy. You're going to be deemed to be applying at whatever age you go to Social Security. You won't have the option of picking and choosing. By the way, nothing that I've talked about in the elimination of the strategy changes what I had talked about in terms of survivors, widows and widowers, having the ability to pick and choose one benefit and then switch to another. This is simply spousal benefits. So again, windows closing, but there may still be some applicability for this strategy for anyone born January 1st, 1954 or earlier. Next slide, please. Just a quick reminder about taxation of benefits. Prior to 1983, Social Security benefits absolutely, completely federal tax-free. That year, Congress changed the IRS code. Said if you were a higher income Social Security beneficiary, you'd be required to pay federal income tax on up to 50% of your benefit payments. How did they define higher income? Well, single tax filer, you had income in excess of $25,000, couple filing jointly in excess of $32,000. Then you'd be required to pay federal income tax on a portion of your benefit payments. That year, only about 10% of all Social Security beneficiaries paid federal income tax on a portion of their payments. But what Congress didn't do was index those two thresholds, and here we are 36 years later. Just be aware, if you're a single tax filer, you have income from all sources in excess of $25,000, couple filing jointly in excess of $32,000, you're not going to be in a position where you'll have to pay federal income tax on up to 85% of the benefits you had received in the prior year. It gets treated as ordinary income tax at whatever marginal tax rate you're at. These days, about half of all Social Security beneficiaries do pay federal income tax on their benefits. At the end of the year, Social Security sends you a 1099 form. You use that in filing your tax return. And just an important reminder, we're talking about federal tax liability. State tax liability varies from state to state. The vast majority of states, 37 out of the 50 states, do not tax Social Security payments, but 13 states do. So if you're going to be retired somewhere, you need to check with the state tax authority and where you're residing to find out whether or not your Social Security benefits are going to be subject to state income tax. All right, last slide, please. Big finish. I always like to wrap up and end where I started. Key message for me is you're making this transition to retirement, learning about Social Security. Just recognize the program's intended to provide you a base of income, a foundation that you can count on being there. But it's a base of income that you must take steps to supplement because it was never intended to be your only source of income in retirement. And the sooner you recognize that, take those steps, the more likely you are to have that comfortable retirement. So hope the information's been helpful. We got about 10 minutes left. Be happy to take questions that people may have on anything I've talked about or didn't talk about.
So once again, use that Q&A button at the bottom of the screen. While some of those questions are starting to come in, and so far nothing yet, so feel free to start plugging away. Still got Kurt for another 10 minutes.
So let me answer a question that we'll anticipate. So question I get all the time, particularly here in the Commonwealth of Massachusetts, has to do with how does the receipt of a public pension based on work not covered under Social Security impact somebody's ability to collect Social Security benefits? Here in Massachusetts, state and local employees and public school teachers don't pay into the Social Security program, but they get a public pension based on that work activity. Huge area of misunderstanding, huge area of myth, so let's try and clear this up. If you receive a public pension based on work where you are not paying into the Social Security program, you're going to be impacted by one or two provisions of the Social Security program. One is called the windfall elimination provision. The other is called government pension offset. The windfall provision, that impacts you if you get that public pension, but in addition to your public service, you have worked and paid into the Social Security program for at least 10 years. And that's what you need. You need 10 years of work under Social Security to vest in the program and to entitle you to receive something down the road. Well, the good news is, as long as you have your 10 years of time under the Social Security program, you will always get something each and every month from Social Security even if you receive that public pension. That's the good news. The bad news is, in all likelihood, the amount you receive from Social Security each month won't be as high as it would have been if you didn't get that public pension, because the windfall provision requires Social Security to use a different and admittedly less generous formula to calculate your benefit. But you're always going to get something. If you have fewer than 30 years where you've worked and paid into Social Security, you'll get less than you would receive if you didn't have that public pension, but you always get something. Government pension offset, though, that impacts how receipt of that public pension impacts your ability to collect a spousal benefit, a survivor benefit, or a divorced spousal benefit. And here the news is not as good, because depending on the amount of your pension, it's possible you won't be eligible for any type of spousal, survivor, or divorced spousal benefit. Because before Social Security will pay you that, they look at your public pension, figure out what 2/3 of your pension amount is, and will offset or reduce any type of spousal benefit, survivor benefit, or divorce spousal benefit you might be eligible to receive by that 2/3 of your pension. So if 2/3 of your pension is more than what you collect in Social Security, spousal, or survivor benefits, you don't get anything more. But if it's less, you get the difference. Why does government pension offset exist? Simple, because when I talked about spousal and survivor benefits, I talked about how you collect on one account or the other at a time. Government pension offset basically extends that concept. If you've earned a public pension based on your own work activity, which exceeds what you collect in Social Security, spousal, or survivor benefits, you don't get both at once. So as long as you've got 10 years, even with that teacher's pension or state or local pension, you always get something. May not get anything more in spousal benefits depending on the amount of your pension.
Okay, we did get a couple questions.
Yep.
Why don't we tackle this one first with regards to, so the question is, when determining what taxes I will owe on Social Security benefits, will dividends or other earnings from my investments be considered?
Sure, and so if you remember on the slide, it talked about modified adjusted gross income, or MAGI. That consists of three things. It is your adjusted gross income from the bottom line of your 1040 tax return, plus any tax-free interest you may have received previously, plus 50% of the Social Security payments that you had received in the prior year. Add those three things up. If you're an individual, those three things add up to less than $25,000, then no portion of your Social Security benefits subject to federal income tax. Couple finally jointly, adds up to under $32,000, no portion of your Social Security benefits subject to federal income tax. Above that, though, you can pay federal income tax on up to 85% of the benefits you receive. But basically, it consists of three things: adjusted gross income, bottom line on your 1040, so it is going to include those taxable dividends and things like that, plus tax-free interest you've been able to exclude up until that point, plus 50% of your Social Security benefits.
That's one of the questions that a lot of accountants get. You know, they say, oh, I thought municipal bonds were tax-free. Why do I have to put the interest on my tax return? It's exactly for this calculation.
And that's it. And now, tongue-in-cheek, you should hope you pay federal income tax on your Social Security benefits, because that means you've got income in excess of those thresholds. Here in the Commonwealth of Massachusetts, I don't know how a couple lives in retirement with less than $32,000 a year, but that's just me.
Okay. Another question we have is there a time limit for claiming the benefit upon the death of an ex-spouse?
So I guess the answer is, so we're talking about survivor benefits for a divorced spouse. So first and foremost, you can't collect anything until age 60 at the earliest. So you could be 55, your ex passes away, you're not going to be able to get anything until you at least turn age 60. Here's another area where it's really important to know what your full retirement age is. Because in terms of collecting benefits, if you're applying for benefits prior to reaching your full retirement age, there's no retroactivity any earlier than the month you actually apply. However, if you are full retirement age or older when you get around to applying, you can request and receive a maximum of 6 months of retroactive benefits based on that application. So full retirement age or older, up to 6 months of retroactive benefits. Under full retirement age, generally, you can't be paid any earlier than the month you actually apply. Although in cases where there's a more recent passing, you do have that 6-month retroactive period, which you can apply up to 6 months after the death and still be paid back to the month of death.
Okay. We have one more question, but again, keep firing away if you have any other questions. Bottom line is a political question here is there material risk that Social Security goes away or substantially reduced in the foreseeable future?
So I get this question all the time, and it's always along the lines of, oh, what's the future of Social Security? Is it going to be there for me? And I always like to answer this first by referring to Mark Twain, who once said, reports of my demise are greatly exaggerated. I tend to think reports of Social Security's demise are greatly exaggerated as well. You know, each year Social Security's trustees issue a financial report on the health of the system, projecting not just what's going on today, but attempting to project 75 years into the future. 2019 trustees report projects that is currently constituted, assuming no changes to the program whatsoever, no increase in taxes, no cuts in benefits, absolute maintenance of status quo. They project that Social Security has enough money on hand to cover 100% of promised benefits each and every month between now and the end of the year 2034. The report then goes on to say, beginning in 2035, Social Security will still have a revenue stream that will be sufficient enough to cover about 80% of the promised benefits. And that's an important point. People talk about, oh, there won't be anything there for me. Keep in mind, Social Security's primary source of income, payroll tax dollars collected from employers, employees, and people who are self-employed. As long as the economy is functioning in some fashion, people are working, Social Security will always have a revenue stream of some sort. The issue is, looking down the road, is that revenue stream thought to be enough to cover 100% of the benefits that have been promised. And at this point, it is through 2034, beginning 2035, only thought to be enough to cover 80%. So the issue confronting Congress and the American public on the future of the program is how, between now and 2035, you close not a 100% funding gap, but you close this 20% funding gap. It's important to remember, Social Security, it's money coming in, it's money going out. So the issue confronting Social Security, not altogether different from somebody's own situation at home. At the end of the month, you don't have enough money to pay all your bills. You either got to bring more money in or pay a little bit less money out. Look at it that way in the same way of Social Security. Close that 20% gap, you can either bring more money in or you can pay less out. But if you think about it, you close the gap simply by increasing income. Who are you impacting? Younger folks, employers. Close it simply by cutting benefits. Who are you impacting? Old folks like me. So I think in the end, if Congress, and they should get around to dealing with the issue, you see a mix of some income increases, some slowdowns on the outflow side, but keep some perspective in mind. You're talking about closing not a 100% funding gap, but a 20% funding gap, and the sooner Congress deals with the issue, the better off we're all going to be. But I think the program's been around for 84 years, so continue well on into the future. It's just far too important.
Okay, final question is on Social Security income as it pertains to having a disabled child. So can you talk a little bit about that?
Sure, and it's important to note, Social Security is really this family protection program. We focus on the retirement side today, but it's important to point out that if someone qualifies for Social Security retirement benefits and has kids under the age of 18 at home, those children can receive an additional monthly Social Security payment up until the time the child turns 18. Now, generally, child's benefits end at age 18 or through age 19 if still a full-time student in high school. But there's an additional category that allows disabled adult children, these are kids over the age of 18 under a disability that began prior to age 22, to continue to receive a payment beyond age 18 for as long as the parent collects. So that's, if there are additional folks who could be collecting, you know, that's another factor that comes in helping determine whether or not maybe you want to collect a little bit sooner rather than wait a little bit. Because again, that child's not going to be able to collect anything unless and until you do.
Okay. All right. Well, thanks, Kurt, and thank you everyone for joining us. I am going to put this disclaimer up. This is something that LPL requires us to do, pretty much saying that don't act on any of the information. It's all general in nature. But that's kind of my my pitch for Kurt and for us, is that that's why you want to sit down and speak with someone like Kurt or myself to actually try to figure out this question. The big one, of course, is when do I actually start taking my benefits? So again, keep your eyes open on our Facebook page, website, etc. We will have other workshops like this. Hopefully this has been helpful for folks. We are going to post this. It's been recorded, so we're going to post this on our website so that if you missed a section of it, you can go back and rewind it and go from there. So I think that's it. I was just
going to say, if you have any additional questions that happen to occur to you, get them in, and they'll get them to me, and I'm happy to answer those.
Yeah, and I'm happy to share Kurt's information. So,
yep.
All right.
Thank you very much,
everyone. Have a good day.